Good afternoon, ladies and gentlemen. We're about to start the final afternoon session of Gold Standard University Live here in Canberra. And how we're going to do it, we have, of course, we're going to still have the two sessions, but this first one's going to be led off by Tom Szabo. And I'll let the professor say something where we're headed.
Yes. Before we start this first session, I would like to take this opportunity to express my public thanks to people without whose help and assistance this couldn't have come about, this particular conference, which which is honored with your attendance. Above all, I would like to thank Daryl and Martha Schoon for creating the website professorfekete.com. This website has turned out to be very important and very significant because this is my way of communicating with the world, which is very impressive, and I must admit this conference was very, very encouraging for me. The attendance from far and wide, people came and people expressed their appreciation is very heartwarming. So I want to thank them for the website and for other assistance also. I would like to extend my heartfelt thanks to the local organizers, Philip Barton and Marcus Matthew. They have been extremely helpful, and they were thinking about problems which could arise, which I never thought about. And we have enjoyed our stay here in Canberra very much indeed. And as I say, without their assistance, this wouldn't have been possible. I also want to express my thanks to Tom Szabo, to Nathan Russes, and to all the others who, with their comments and statements, and in the case of Tom and Nathan, with their longer exposition for which they had to prepare, they also had to raise the level of this particular conference. So this is, and I also want to thank all of you for your coming, and I hope you got something out of it. I can assure you that I did. It's a give and take. It's an interactive seminar. I have learned a great deal from various comments, and I'm very grateful for that. So with that, I let the conference...
The show go on. All right.
Good.
All right, Tom?
Okay. I'm going to back up a little bit because when I did the explanation yesterday, I think it was how to calculate the basis, I made actually, I'm not sure it's a mistake, but maybe it was a subconscious sort of error, maybe. And I've done this now 3 times, and every time I seem to make a small little failure to exactly do the calculation correctly, and maybe it's because, I don't know, I want to test you guys to see if you could, That night you went back and actually tried to calculate, you came back to me the next day and said, hey, wait a second,
He was wrong.
This calculation doesn't come out the same what you said it does. And we did have one person here, Osman, who actually came back today and said, well, no, to do the annualization you actually have to do something slightly different, and actually that made me think that there's something even beyond that. So what I want to do, if you let me, is sort of try to redo this calculation pretty quickly here. But I've actually now done the smart thing, which is used Excel to do the calculation. So I merely need to write the numbers down and not have to be up here, trying to do miraculous calculations. So we had the December 2008, 710. Whoop. See, I've already got that wrong. That's right. Okay. Here's the spot. $2,700. So we had at $10 a contango. Then at the time, I think we said the expiration was for this was December 1. The date here was November 13th, so 18 days of difference. So we wanted to get a daily rate. Okay, the $10 is sort of a rate for 18 days. To get a daily rate, we have to divide the 10 by 18, and that number, I think someone got that right. They even said 0.555. I think it was you, and I didn't believe it. 0.555.
It rubs off.
It's 0.555.
At least when you said 6.
That would have been strange, right? And then that's a daily rate. Now we come up with an annual rate times 365. Get an annual rate, and that is actually 202.78. Okay. So in 1 year, at this same rate, the difference between the spot and the futures 1 year away would be $202 different. Okay.
That's dollars.
This is right. These are all
It's
dollars.
all dollars.
I'm sorry. This yeah. In fact, it's all dollars except the days right there. Okay. So it's 202.78.
Yeah.
Now, of course, you know, to come up with what this would represent as interest, you divide it back into your actual price. Okay. But the important thing is that actually makes difference that you want to divide it into your cash or spot price.
Yeah.
I don't know why that's the case, but when this thing gets extreme, that seems to be the better way to do it. I haven't spent enough time to figure it out, but I'm sure maybe someone can even right now figure that out. But anyway, so you take 202 divided by 700, and then you would come up with annualized. Okay, come on.
28%.
28.97.
Oh,
29%.
it's not running. Rounding error.
Round it down, huh? So 28.97%. So that would be essentially your contango in this case. Obviously, it's too big because I just took some assumed prices, and this is a number that I've said is, tends to be around this 5% maybe. Okay. So with this now, are there any questions? A day later, 2 days later?
That's just a comment. That's very, very rough because that ignores, for example, how frequently interest would compound. Then as an annual rate you get there, but that assumes annual compounding rather than daily compounding or monthly compounding. So
Yes, but I'm going to calculate this rate every single day.
yeah, but
So I'm going to use
you
a
end up
consistent.
every single day with effectively an annual rate that is based on a very simplistic calculation.
This is how it's done. I can't, If you calculate the forward rate that you get LBMA, this is the way it's done. But I would say that yes, if you're doing this as a monthly or through 2 months or 3 months, and using comparisons, you will probably see this compounding, play into it. But since I'm simply using it on a relatively consistent basis here, I'm not taking a year versus a month. It's just going to be close enough. For
But that
The
can't
point
be
is
right
that you
now.
apply it consistently. That's
Correct,
useful in
correct.
that sense.
Just like I would apply this, I wouldn't, necessarily, say December 1 is the date for this futures, even though this particular futures may be still the spot month into that month, because if, as I said earlier, if there's a lot of deliveries taking place, this won't roll to the next month until later. So I'm making some
Still something
assumptions.
wrong with it, Tom. And this goes back to high school where we had to check our work. If you don't do it on a daily basis, try it on a weekly basis. Say you've got 2 weeks, not 18 days. Okay,
Right.
that's 1/26th of a year, and so 0.55 times 26 isn't 28. It's 13%.
Okay. You're right. I usually actually do this as, I don't even use this as a 365 here. So actually my own calculation is not even this
It's
precise.
working day.
I do it by month, actually.
Okay, but that figure just plain wrong. It should be 13% if you calculate it by weeks.
But if you calculate by weeks, you're going to take this, you're going to have to round this
You're going
number.
to take 26 times 0.555, which is about 14. That's double the amount for some reason. I don't know why. But you've just got that difference between doing it on a daily, annualizing on a daily rate or a weekly rate.
That's just 2 weeks.
Yeah, but you've got 2 weeks. You're taking your .55 over.
It's 2 weeks plus 4 days.
2 weeks won't be 0.555 anymore. It won't be 18 days.
Well, but I'm saying
No,
that
there's-
a surrogate is a rough check. Each team is about 2 weeks. We'll make it 3 weeks.
Your number is going to, I think it's going to be off a couple of percent. It's not going to be off by half. Since intuitively, you change $10 in what this is 2 weeks, 700, how much, what is that percentage-wise? And that's the other way to do it. And whether you multiply that by weeks or days, it's not going to make a difference.
About .0014.
Right, but this is, like someone said, this is not going to be.
No, it's adjustment.
So, in any case, this is the calculation. This is how it's done. That's the wrong answer. So guess what? When I do this calculation using the COMEX futures for the last 2 years, I come up very close to what the forward rate is at the LBMA. So, if I'm doing it wrong, they're doing it wrong. I can't.
They run
I
about
can't-
going back, so.
What's that?
See, Tom,
You come up here.
this is blowback for telling them it was a test.
Okay.
You see, they caught it.
I knew he was good.
This is a rashy crowd.
Exactly. But okay, so we could take that. You're right. I mean, if we wanted to really, do this to the absolute. But the fact is I actually use a monthly. Okay, I put this as a fraction. I only use days, and I come up with typically a very small difference from the forward rate that gets published at the LBMA.
And that's about 30%.
No, because this does not exist. The 7 and the 710 does not exist. You would never see this. You would never be this different. I should have probably used a real number. So I use a fake rate here. Okay. So, but I want to use the same one that I used consistently yesterday, so
Fine,
that
Tom, okay, we'll correct that. I'll let you do this.
do the calculation please first, and then write it. Because I'm right. I've done it for 2 years. You haven't done it. You've done it in your head. Had you done it last night, like last month? Because what number did you come up with? Pretty close to that number,
I
right?
didn't do it that specifically. I just gave you the formula.
Okay. So having done that, and that was very successful.
Before the camera.
Nice sort of I'm going to try to do a couple of charts here to try to demonstrate. Where are my charts here? Okay, here we go. You might use bimetallic arbitrage as a trading tool. And what I'm going to do is this chart I'm drawing, I'm actually going to give to Philip, so when he emails people the PDF files or thereafter, you guys can also have this chart. So you just don't have to remember this kind of fuzzy thing that I'm going to draw up here. But, this is one. So, and we'll see this time by time here. Okay, so we have time scale here. We have a scaled ratio here. By ratio, I mean we take two values, divide them against each other. The green line represents the ratio between the price, the daily closing price of the silver ETF, whose symbol is SLV, and the gold ETF, whose symbol is GLD. And actually, so it's GLD divided by SLV. So both are 100. Then this green line is around 1. Okay. Now, in order to get this number to 1, I have to divide 1 by factor, because actually 1 ounce, the SLB represents 1 ounce of silver. It's actually more like 10. And the GLD is 1/10. As I recall, right? 1/10 of 1 ounce. Right now it'd be more like 7. So this would actually be 7. And you say, well, why do I have it at 1? Because I've simply moved it down the chart so that it's consistent with this other line, which I'm going to explain in a second. Okay.
So you just subtract 6.
Okay, subtract 6. I don't know the actual algorithm. I might have actually done it in a smarter way, so that because you might tell me when you subtract 6 and these numbers change, it's going to be off. So I didn't really subtract 6. I probably did it correctly with math, but you can review it later if you want. It's tough audience. Okay. The black line here is the ratio between the gold forward rate and the silver forward rate. Okay, and these are the numbers that you get out of the LBMA website that I earlier suggested that you go look at if you don't want to make these mistakes calculating the basis, or to check it, because that's what I do almost every day. And so if, in fact, let's use the number here, I'm familiar with 4%, and both are 4%, then you're at 1. Okay? So it means that both are at near the same rate. This line is going to be right around 1. If both of these are relatively at the same constant rate, that should be right around 1 once I've made the adjustment. So there's an interesting thing here is that this is just one snapshot at a time. If you go back, there's other things happening.
Sorry, can I just ask, what's the forward rate?
Okay.
Is that
The
release
forward-
rate or not?
Forward rate, you know that calculation I just did a little while ago? That 28.97%?
Yes.
Okay. So this is in fact the contango. The forward rate is a number that you can get from the LBMA website. It represents the amount of premium you would pay for silver or gold that you sell in the future compared to selling it today.
Isn't that just the prices?
In effect.
Right. So it's
I mean, they don't. It's not exactly, but I come with usually within a few cents when I do this other basis calculation here.
It's,
So
it's their calculation of the basis, would you say then?
yes, it's the LBMAs, and the reason that I would want to use this is because this is one we can agree upon, meaning that we don't have to argue that you divide by weeks or months or that there's a daily compounding or whatever, because however they compute it, it's there on the website, and it's just a neutral way of doing it. So, but in any case, there's an interesting pattern here that it's very clear when you get the charts too, that there's a period in here when there's relative stability between both, and which in effect meant that gold and silver as represented by the proxy with these ETFs. And the reason I use the ETF again is because it's very easy to get the daily closing prices of the ETF. There's no question about what type of gold it is. You get it from Kitco, blah, blah, blah. That's just, wherever you get that price from, it's going to be the same, because it's just the closing price of those shares. So you can see that during this period, and this is roughly up to 7:30 here, you had a relatively sort of stable relationship between the two. One way to interpret this, and the way I did it, is that there's really not a lot of advantage to buying gold or silver. Or another way to say it is that if you're buying gold and silver and you don't have a preference for one or the other, you might buy 50-50. Okay. Is that
No.
Okay. You might still see some little things in here, and if you were really adept at, track the basis and looking at some smaller periods, you might have some trading or whatever opportunities in there. But on a macro scale, that's pretty obvious to me. Then what started happening here And this 730 points is coincidental to the sort of top of the commodities market where the credit prices really started to become entrenched. These two lines started diverging from each other. The green one being the ratio, the gold-silver ratio, meant that the price of gold was in effect appreciating against silver. Although both were going down, another way to say this is that gold was going down slower than silver was. At the same time, this line here is the ratio between the two sets of bases, so that when it goes down this way, what it means is that the gold basis is lower, or the gold is going toward backwardation, in effect, faster than silver is. And as we recall from earlier what the professor was saying, that as a bimetallic trade would say that you should be buying silver. Okay? But if you, and it's a long way to demonstrate this, but it's not just a signal that says, well, let me try to time the market, and as soon as I see this starts to go down, I'm going to be buying, a bunch of silver. Because if you did that, you would have made a really big purchase of silver right here. You said, oh my God, this is a signal, gold, I should be buying silver now, I'm going to buy a bunch of silver here. But as you can see from this chart, you had a couple months, this, here's 1023. Okay. Almost 3 months during which gold continued to relatively appreciate compared to silver, and gold continued to get further and further, or closer and closer to backwardation in relation to what silver was doing. So, and I mentioned this a number of times in the last few days, to me this is a signal that you're accumulating more and more silver. Okay, until you get a change in direction. Possibly. Now this, we don't know when this is going to play out. We see this, and I'll talk about this in a second, going up this way, but it could very well come down and end up back here. But this is all about probabilities. This sort of looks like a topping pattern here. Of course, you don't know until it's topped. But we do know that there's a trend in the ratio this way up to this point, but then started to reverse. And if I'm trading this, and I didn't trade this myself this way, what I was doing is I've been switching my options. I have options in various matured, there's periods out. I've been getting out of gold options and increasing my exposure to silver options. Okay. But if you're trading this as an accumulation strategy, what it would say is that as long as this pattern is consistent, you would buy more and more silver, or a greater and greater amount of silver in relation to gold. For example, if you're buying weekly, this represents the amount of silver that you're buying. You're buying a greater and greater amount. And then once you reach this point here, you should be prepared to reverse that strategy. And it could very well be that this, sort of, who knows, this could drop down pretty quickly. I mean, silver could go up $2 or $3, and this could completely reverse. But the indication here is that you've had this period here where sort of you were able to be neutral, where someone might have said, oh, this is a great time to buy gold, or this is a great time to buy silver, one or the other. It really didn't make a difference. Here it starts to make a difference, obviously, that you should be buying silver.
Where's today on that chart, please, Tom?
I'm sorry?
Where's today on that chart?
Today is right here.
Okay.
So we've had this. So we've had the gold sort of go further and further into toward backwardation compared to silver, and then now there's a reversal literally within, this is probably the last 5 or 6 days or 7 days, where silver's dropped from a rate of around 2% to almost 0. It's actually past gold, so it went beyond this 1-to-1, and now silver is actually closer to backwardation. Okay.
Tom, can
Yes.
you give us a sense of the magnitude? You just got 1 there. Was that 2 or close to 2
Yeah.
or 1.8 or what was it? 1.2?
This top right here is like 4. But because both gold and silver are pretty close to, they have a very small contango now, since this is a ratio, you amplify any sort of move. And this is what I said earlier, that you can look at it in two different ways, because another way to do this exact same chart, and I have it at home, unfortunately I don't have it on my computer, but is to subtract the two from each other. So this black number might represent 4 minus 4. One subtracted from the other, and then this would be a 0 here, and then it would just be the net difference between the two. You wouldn't see such a clear pattern from that. And that's one, but you would probably see some other things that you don't see on this chart. So, and that's why I said that I don't think you have one signal. Even if you're just doing this, I think at minimum you want to do both of these charts. And on my website, I'm going to be doing both of these, not just for this, but sort of all the other basis calculations, because you see a lot of different things that you miss on one chart. You don't see the same thing on the other chart, but the pattern on these trends on the other chart are much better than this one. I'm not saying that this, it's time to now rush out and, start buying gold. In fact, silver is still at a pretty high ratio compared to gold now, so you may still be buying silver, but be prepared that this could, pretty quickly change, regardless of what happens. If this reversal comes up like this, and everyone in the world is saying, "Oh my gosh, it's time to buy silver," and let's say the silver ratio goes, it's really dropping down into here, this green line. A lot of people might be saying, buy silver, it's so cheap still, even though it might be 30, 40. This would be saying no. Buy gold now. Okay, and that's, I think, a very powerful, because it almost acts against the market, acting against the crowd, and you may not really know what's up without something like this. This is telling you what's up. What's really up. Any questions on this chart? Go ahead.
Where you're accumulating more silver there, does that point cuts off at the 23rd of 10th when those bases?
Could you repeat it louder?
Just where where the gold forward rate starts to kick up there, that's where you that's where you stop accumulating more silver than gold, or a greater proportion.
Not necessarily. It may just mean that you maintain this, whatever this percentage. Like, let's say here it's 50-50. And then you're here like, maybe 70-30, maybe you're 80-10, or 80-20. So better than that. Okay. So maybe you just keep that 80-20, going here until this sort of thing is confirmed. If we have this sort of, come up here and start doing this, that's one thing. It drops back down here and then starts, hanging out down here again. So you don't really, this is dynamic, so you have to see what this chart does over time. But at this point still, if I was to say what I do next, I would still do 80% silver, 20% gold. I just know that this is going to be switching pretty quickly. From a trading perspective, though, I maybe sort of being maybe a little bit more risky or whatever, I'm already sort of saying that from a speculatively, I think there's something going on here that's it's obviously different than what's being going on. It seems a pretty strong signal that there's a reversal. And I've been in gold. My options have been in gold. I've done relatively well with that, obviously up here. And I've been switching into silver here, anticipating that reversal. Any other questions? Okay, what time do we have? So how long?
We have 10 more minutes.
Okay. I'm going to demonstrate another sort of tool that the basis provides. And this one is going to be another chart. And I wish I could, but I'm going to send you this one too. So everyone here will know this chart. But what I do here is I take the Kitco spot price, and they have these pretty big blow-up charts that you get on their site. They have the little ones that you see everywhere, but if you go on their site and you click on their chart page, you get this nice, pretty big chart, and it's like kind of black background. And there's the, let's actually do it with this. Hold on. It's okay. Any silver. So this is the silver price on September 16th. Spot price, Kit Coat. One day. More in here. Okay, so the chart looks sort of like that. Here we have the green line. Here is the the price of the again the SLV. That's the silver ETF. I've almost become obsessed with these ETFs in the last few months because I noticed something that a lot of people haven't, which is that these ETFs are creeping up in terms of dollar volume compared to the amount of trading that takes place on the COMEX and on the London market. And what that means to me is that these are becoming dominant trading tools, not just for small players, but large investors as well. Okay? And the interesting thing, though, about the silver ETF, just a couple of minutes on how it works, and the gold one as well, is that it's not an active sort of fund. There's not a manager out there that says, now's a good time to buy silver because it's cheap, or now's a good time to buy silver for this fund because it's trading below its the value of its, the silver that it has in the fund. This is what's called a passive ETF. And what that means is that it has authorized participants who are essentially market makers, who are given the exclusive right to buy and sell shares of this ETF by delivering bullion, silver or gold bullion, silver in this case, to the trust where the ETF silver is held. And specifically, to give you an example in this case, is that the ETF here is clearly trading above the spot price of silver. So, as an authorized participant, what this means that I could do is buy silver in the London market, physical silver, 1,000 ounce bars of silver, deliver it to the ETF, give it to the ETF, and this is all allocated bullion, so you don't physically pick it up. You simply call up a warehouse, buy the silver, and then you say, well, this is actually going over to the ETF. It's a very fast transaction. And then when you deliver it to the ETF, you get a certain number of shares. Okay. What you get is, and I'm trying to do price of it. So you buy silver at 1020 spot, and you deliver it to the ETF, and you get, and this is they're called baskets that you have to do it in certain quantities, and it's 50,000 shares. So that's 50,000 ounces at a time. Okay. So you pay. I'm not even going to try to do the math, although it's pretty easy because I'm sure we'll find some problems with it.
I'm busy.
Oh, you're busy. Okay, all right. In that case, I'll let you do the math then. And you get 50,000 shares. And then what the authorized participant does is that he or she will sell these ETF shares and try to get the 1040. Okay? So essentially they're making 20 cents. They're buying silver for less and then effectively selling it once they get the equivalent shares for 1040. And what that tends to do, of course, is that it introduces new supply of shares and will tend to close this gap off. It's called an arbitrage opportunity. And there's several authorized participants at any one time operating this market. So if one is asleep, there's another one that may say, well, this is pretty good. 20 cents times 50,000, $10,000 for making one phone call. Selling the 50,000 shares, you might have to have a broker there for a few hours, putting that in the market. But $10,000 for almost nothing. But this is all day long. The number of shares that are traded in the ETF may be 10 million. Okay, so this is the arbitrage opportunity, and this is why you expect that the price of the ETF and the spot price in London are going to track very closely. And in fact, this might look like it's pretty close because this is a difference of day of roughly 10 or 20 cents, but it turns out that on a typical day for the last couple of years, almost every single day, the difference between these two are something on the order of 1 cent, 2 cents, 3 cents. So it might look down here. Just visually, it might look more like this. And I've done this for many, many days, weeks, months, and this is what you usually get. On September 16th, this is what we had. So how is it that, what's going on? Maybe these authorized participants were just asleep that day? No, because actually for the four days previous to this, you had something similar to this, getting larger and larger. So this is obviously a form of basis. It's a difference between two sets of prices, even though the SLV price isn't really a futures price. It is technically because it actually takes the authorized participants one day. So when you buy the silver, you don't actually get credit for the shares until the next morning. And I think this is where the key is to this. So this is a one-day lag, and that could sort of introduce me to this type of thing. If the authorized participants are not able to buy, this is my theory, silver consistently because of maybe the amount of demand on the market at that point. And keep in mind, this is not just back and forth trading. When someone calls up to buy buy the silver for the fund, this is going into the ETF's holdings, and as we know over time, those holdings have just been increasing. So this is demand that essentially taking silver off the market. It's a little bit different than most of the trading that happens in London and almost the COMEX and everywhere else, which is you open a position in the morning, you close it at the end of the day. This is a position that essentially stays open at the end of the day. But my closest I can get to sort of understanding this is that, in effect, there was physical demand or supply that was out of balance in a bullish sense. Okay. Now I don't know if there was a less supply or more demand. Clearly, though, there's something going on here because this is not normal. And it had gone on for 3 to 4 days. But then what happened if I do this chart on the 17th and continued the price of SLV or the other one here? This. But as we got this, like this, okay. So at some point it caught up, clearly, right? Let's say this goes back a while, okay, and that's actually to say it was one day. To me, this looks like a trading opportunity. So if there's a signal that the basis provides that's a true trading signal, this is as close as I've seen it come. And intuitively, I think it would make sense. I don't think we need to go even too far. Like I said, I mean, this is clearly, there's more demand, spot demand, and when the ETF is trading at these rates, well, I take it back. So it's clearly more demand for the ETF, right, than the amount of silver that could be purchased on a spot market at the same time. Okay. What I would say is that there's demand in the physical here, and that's why you're not able to buy enough silver to cover the ETF demand. And the interesting thing that happened here, if I got my dates right, is that AIG, I think, failed right around, I think it was 17th or whatever. But at the same time that silver was doing this, it went up. Actually, the range that it was, I think at the beginning of this day, it was like 10, 20 or something. It literally went up like $2 and something that day, the 17th. And silver or gold went up like $110. And you had pretty much exactly the same thing in gold. And it started a few days earlier, and then they announced AIG the next day, and then this whole thing was over. So, I mean, I'm not a big conspiracy theory person, but someone knew something about AIG and what it was going to do and what AIG had and what that was going to do to the price of gold and silver. And they were buying, and I didn't see anyone else saying anything about this, so no one really knew, so they were buying surreptitiously. And by comparing these two sets of prices, and essentially as a basis, you should have been able to take advantage of this. Okay. Going back, I've seen 3 or 4 episodes that were similar to this, but not as significant. However, to me, this was clear enough that I should have taken more of a position, but I did take somewhat of a position on this and ended up making a little bit of money. So this one's, I could say, is a basis indicator, a true price indicator where I've made money. Once at least, but you know, I've only been at this for a little while. Okay. Any questions? Good.
So, as the price went up, the deliverable, the spot price followed it, and eventually the gap closed. Yeah, that's what you're saying. So the supply.
It took a while. It took, you know, I'm stretching this out a little bit, but as the price eventually at this higher price, it did close.
So as the ETF price rose, the supply of silver obviously rose too, and as the gap closed that way. Or the amount of buying on the ETF fell off at the higher price. I don't know which side it was, but there's a distinction here, right? I mean, if this gap continued this way, right, as opposed to coming together, I wouldn't have exited a position here. I would have waited until that gap closed. So who knows where it would have stopped? 12, 13, 14, 15, 16, 17, 18. Okay. It closed here, so obviously I stopped. But what I'm saying is that it's possible that the next time or another time you could have a similar type of setup, but it just doesn't close.
So you keep on buying.
Or you hold that position that you opened when you saw this gap open here.
What does it indicate if it doesn't hold?
Well, if it doesn't close, it means that someone else might answer
The pattern
that.
will continue. The pattern up will continue until the gap does close. That's what I mean.
Well, I'm not sure. I can't be certain that the pattern will continue. What I can be certain of is either that there's more demand for the ETF or less supply in the spot market.
Which will tend to increase the price.
All other things being equal, no one else sort of being surreptitious.
We are talking backward.
And we're talking a lot of different players doing a lot of different things in this market. But there's clearly some big players in this market buying the ETF.
It's going to be very interesting to see, because eventually silver will do another up leg, you know, just from a pure Elliott wave perspective. It's going to be very interesting to see what it does on the next up leg with silver.
Well, I track this, you know, pretty frequently. I'm trying to actually use, mentioned earlier, e-signal. I'm trying to see if I can get, so I don't have to draw these charts, because these charts are actually pretty difficult to construct. I literally take the Kitco chart, I take a copy of the chart of the SLV and then resize it and then lay it on top of the other one. Some of you may have already seen it. And when I email it to everyone, you'll see that it's a weird way to do it, but it's actually the least time consuming right now, but it's still about 20 to 30 minutes a day. You've got to, there's other things in there too. For example, you can't just put the two prices on top of each other because the ETF has a deduction over time for administrative fees. So for example, the ETF price here, I said it was 1040, but really, let's say that's the amount of silver that's in the fund, 1040, but the ETF is trading at like 1025, okay, because it's had to sell. So another way to say it is this is not 50,000 ounces, okay? This is like, they sell the silver seed to pay for storage fees. So over time, you're not getting 50,000 ounces here, you're getting 49, whatever, 370. Is that the right calculation?
That's how the calculation.
Well, you should know. It's only been around for 2 years, it's 0.5% per year.
Oh, well, that calculation.
Okay.
Sorry.
It's probably actually not that far off. Okay, so because it's a little bit less, when you multiply the 1040 by this number, it ends up being. So I have to move the chart to get the two to be on an equal footing.
So
Nathan.
sorry.
Who's next?
Tom,
Let's let Nathan first.
Can you just clarify your conclusion there? I thought you were saying that the trigger on that September 16th day was that you saw that the gap had closed, that the ETF and the COMOX had come together, and that was sort of a signal that you expected the price to start rising for silver. But then you said if the gap hadn't closed as it rose higher, you would have not exited your position. Can you just clarify that again? You mean the gap may have reopened on the way up, but if the price was still moving up, you would have hung on, or
might have stayed open.
The signal was at the opening up.
The initial entry signal is the opening up.
Oh, okay,
The exit
correct.
signal is the closing back down.
Okay, sorry.
But in effect, what happened is that it didn't truly fully close down. It continued at a much smaller rate for a while, but then I started seeing the price just kind of vacillating, and then of course, it came back
Sorry, I
down.
misheard.
But this sort of works in the other examples actually, could be told that I've seen this is where it's the opposite, where I actually sold. But meaning I didn't go net short, but I sold. And it did go down, and the ETF dumped 10 or 15 million ounces. I forgot what it was within a couple of days of that. This is actually another way, a pretty dandy way of predicting whether the ETF is going to be adding silver or not. In this case, they didn't actually add that much. It's pretty clear. They weren't buying it, they weren't closing the gap, but sometimes when when these two are closer consistently for 3-4 days, you'll see them. They'll add 3 to 5 million ounces. I'm talking about the SLV, add 3 or 5 million ounces of silver within a week or two, which is a pretty good clip.
So in a sense, when the gap opens up, that's backwardation.
Sorry?
In a sense, when the gap opens up, that's backwardation because the spot supply can't meet the demand.
I can't say because this is interesting. SLV's more paper.
But it's the physical supply
Right.
can't keep up with that demand, which is a form of backwardation.
But see, the demand is being driven by the paper. So it's like a weird one-off.
How do you say that? Because ETF is physical. They've actually put the gold simulation.
They do, but when someone buys the shares of the ETF, typically someone else just sells it to them. It's not the authorized participant that's bringing you silver into the market to create additional shares.
Yeah, but I mean, isn't that what the basis is? It's the physical demand present versus some piece of paper in the future.
It is, but I would tend to think that if we were in sort of this monetary crisis when everyone's scrambling after the physical, they won't be scrambling after the ETF. They'll be scrambling after the physical. So the ETF may trade at a discount, maybe, but I could be wrong because look at Central Fund of Canada trading at 10%. It seems like the more there's problems, the bigger premium they trade at. Although I guess they're more fit. What's that?
Central funds and our fund, much clearer custodial arrangements from what I can see.
True.
Not being a conspiracy theorist, but it's just a simpler chain of no sub-custodians.
Right, and it's possible too that because they represent a valid alternative to people buying physical bullion, because premiums on physical bullion might have gone up, they're willing to pay a higher premium on central fund. But I don't know. But it could also be, hey, people couldn't buy, retail silver. There's not any available, so they bought the next best thing. But it still says the same thing. There's no physical available, and they're already past something else. You might expect. Now this is just probability. Did I know that this was going to happen? No. But I'll probably say that every time this happens and it all goes down like this, we can pretty much just abandon basis as a indicator, because, or maybe we just go the other way and say, no, we're totally wrong, it's all backwards, let's treat it the other way. I doubt it. Simon, go ahead.
Tom, so SLV represents the future price one day ahead. Is that how you?
Yeah, in a way, yes.
So
But I'm not saying that that's why there's this basis. But it may be explain part of the reason, the reluctance for the authorized participants to essentially close this gap. But I mean, think about it. If you have 50,000 shares in a basket and you're on good first name terms with an authorized participant, you can ask nicely, and they'll turn in some of these shares for silver for you. But it's going to take a day, so you don't have it today. So in a way, I guess it is a day off from having physical. I haven't really looked into the implication beyond that into this, but there could very well be an implication.
Isn't the spot price itself like 2 days in the future? Like
No. This is Bron. You mind
spot
explaining?
market was a 2-day settlement.
Yeah, 2 days. That is in itself a kind of futures.
But that's different. I mean, spot is taken to be.
Yeah.
It's not real. That's not a future. That's not saying that you settle. I mean, ASX is 3-day settlement. Is that a futures market?
Right.
No, it's just that everything settles in 3 days. So.
Yeah. So, but what the saying is, if you turn in the ETF, you're adding a day to it. So whatever you would settle at in the spot market, you're still adding a day to it.
It seems to me, Tom, that might not really be a basis difference that you're identifying there. I think it's a very interesting difference, and I think it might, in fact, give you trading signals. But isn't that really just saying that at the price that the spot is, there's more demand in the ETF than can be closed by people buying on the spot market, even to earn a fair arbitrage? And that isn't exactly the same as the basis.
Correct. It isn't exactly the same as the basis, but it's a very similar concept. These are forms of silver in different locations, trading on different markets. And truly that the basis as we understand it is a difference in time and place. This is a difference in less of a difference in time, but it's a difference in form also. Right. I'm using basis here in a more sort of generic sense, but this one I don't know why is working pretty clearly. Now maybe it won't in the future. Maybe all you guys start seeing this next time.
I want to say
and then it closes.
a couple
Okay.
of sentences
But this is where it is right now. But you're right. I would say it's a form of basis. I wouldn't call this the gold or silver basis. But it shows once you start, because I didn't start doing this until very recently, and it was all about trying to compare different markets. But it definitely, I think it demonstrates, even if it's not classically the basis, that what you can start doing when you sort of open up a little bit and see how, this is how professional I think we could probably look at things too. I mean, this is really an arbitrage here. But this is something that we can take advantage of as a price indicator. Not because we're going to buy the spot and sell the ETF, but if this got wide enough, you might even be able to do that, But I don't think it's going to get wide enough because why wouldn't the large bullion dealers close it before that?
Well, I was going to say, I mean, we're assuming that the Kitco price represents the actual spot price. And as per my discussion with you yesterday, where does Kitco get this price from and how is it calculated?
Right. But if this was only a few points, but this is 4 days. You're not going to have 4 days of discrepancy. You might have an hour or two, and you might have a little bit, but this is a very clear. So if this can be this far off, then everyone that's trading off of a spot price for 4 days has got a bad price. So I see what you're saying, and I've seen it too. The Kitco price where it's like it's off, because I have a page where I have 3 different versions of spot price feeding. Sometimes they're off on gold like by $10.
Yeah, it's just that I've heard that Kitco's use the Bloomberg data feed. And what they're feeding is the Bloomberg price, and whereas most people we know will use Reuters for their indication of where the wholesale market is.
Right.
So maybe the Bloomberg people who are feeding that data are not as many, and therefore it's not as reliable. I don't know, but I'm not sure.
Okay.
To be watched and analysed further.
Right.
Well, perhaps you
What
could
I do
test
know is
that by
that typically it's right on.
Close, so it seems to work. Yeah.
it's right on. And I know that the Kitco typically is right on with the with all the other prices.
Yeah.
So, okay. Are we done?
Yeah, we're done. Before we end this session, I want to have Marcus to say something, then the professor.
Thanks very much, Daryl. Just following on from what Daryl mentioned a little while ago about When Money Dies by Ferguson. If there's anybody else, I've heard a couple of people talk to me about it. If there's anybody else here who's heard of this book, it's very regularly mentioned by Jim Poplava, and he tells everybody we've all got to read this book. I have actually emailed him saying it's basically completely unobtainable, but he keeps mentioning that it's something we should all read. But if there's anybody else here who is aware of it and like me has been unable to obtain it, but is interested in getting hold of it, if they come and see me afterwards, I appreciate it. Thanks.
When was the book published?
1974.
74. All right. I want to take this opportunity at the end of Tom's presentation to beg your indulgence for all the imperfections and shortcomings which we obviously have, and I include myself in this. But at least I hope you feel that you are compensated by the fact that that's the only place in the whole world where a discussion and study and research on the gold and silver basis is being carried on publicly. I'm not saying that other people are not doing this, but they will not share the information. We here are dedicated to the idea that whatever we find out, we are willing to share with all the interesting parties. So I hope that you will excuse whatever imperfections we may have at this stage. We are working on eliminating them and carrying the research to a higher level. So with this thought, I think.
Yeah. 15-minute break. See you then.